Good day everyone. This paper is entitled Portfolio Selection of Semiconductor Companies in the NASDAQ Market During COVID-19 Pandemic. The authors are all from Mapua University, Philippines, namely Justine Orfe, Juan Magsimbal and Michael Young. All authors are from the School of Industrial Engineering and Engineering Management. Here's the presentation outline. Introduction, methodology, results, and conclusion. Let's discuss first the framework of portfolio selection. To select a profitable portfolio model, we need to have a return estimation, assign a likelihood in that return estimation, and lastly, select a portfolio based on our preference. Before we proceed to return estimation, we need to know first what an investment portfolio is. The investment portfolio is an allocation of different investment instruments in your investment chart. The objective of an investment portfolio is to avoid losing all your investment in one asset. For example, if an investor puts all his money in one stock and that stock goes bankrupt, all his money will be gone. What if the investor puts only 10% in that stock? The investor still has a 90% investment left in his investment chart, which has a chance to generate a profit to break even or surpass the 10% loss. That's how the investment portfolio works. Let's continue to return estimation. In return estimation, we need to have an investment pool, set criteria in our investment pool, and qualify it for our investment portfolio. There's a lot of financial instruments we can choose from: stocks, bonds, mutual funds, and many more. After setting criteria and qualifying the assets in our investment pool, we can now forecast or estimate our investment pool's future performances. The investor can configure their investment pool by setting it into a long position or short position investment pool. For a long position investment pool, you estimate that the assets to go up, so you buy low and sell high to get a profit. In a short position investment pool, you estimate that the assets to go down, so you initially sell high, then, later on, repurchase it at low prices to get profit. Whatever your criteria for the respective investment pool, you will estimate the assets' possible performances inside these investment pools. Common estimates are historical returns, average returns, or generated return scenarios. Now that we have our estimate, we need to determine the likelihood of the scenario happening. What is the probability that these estimates will occur? And what probability assignment strategy are we going to use in these estimates? The naive way is to assume equally likely scenarios. Or we can apply SP&A theory. SP&A theory states that when fear is present to people, they will expect a bad outcome scenario. The same goes for hope. When people are happy, they expect good outcome scenarios. Applying SP&A theory, scenarios are ranked from worst to best and then assigned appropriate weights based on an investor's fear and hope levels. If the investor is very optimistic, hopeful, on the market, they will assign more weights on favorable outcomes or best return scenarios. And if the investor is very pessimistic, fearful, on the market, they will assign more weights on unfavorable outcomes or worst return scenarios. After assigning weights on estimates, we need to select a strategy. In this study, we used a safety-first model. Why the safety-first model? Each investor has a different goal and risk level. This model gives an investor peace of mind. Setting a threshold return means an investor aims to reduce the risk of not achieving the investment return. The first rule of the safety-first model strategy is to have an acceptable investment return while limiting investment risk. In summary, portfolio selection research is summarized as follows. First, identify the investment pool and determine the return estimates. Second, assign the appropriate probabilities to these return estimates to generate possible scenarios. Third, utilize a safety-first model in the portfolio. Fourth, evaluate the portfolio performance by comparing it with a benchmark market. We considered 39 semiconductor companies with positive earnings per share growth for the past 5 years for this research. Positive earning per share growth for the past 5 years serves as our criteria for our investment pool. We based it on Benjamin Graham, author of The Intelligent Investor, published 71 years ago. He states that avoiding companies with negative earnings per share growth during the past 5 years will help you stay clear of high-risk companies. The semiconductor industry is responsible for manufacturing integrated circuits, microprocessors, memory chips, and complex systems in a chip or, in layman terms, are the heart and brain of millions of devices of different industries, including aerospace, automotive, smartphones, home appliance, medical, and many more. Also, semiconductor companies have a significant role in innovating our technology products. In the British stock market during 1990, Blunder's study that innovation correlates with the company's market valuation. Now let's see if the semiconductor industry's fast-phase innovation could be a factor for outperforming the benchmark market. For this study, the proposed portfolio selection framework are as follows. First, semiconductor companies in NASDAQ were qualified based on our criteria. Second, companies that pass the criteria are added to the investment pool. Third, historical returns are considered as the estimates for future performances. Fourth, for the likelihood of these estimates, SP and AE theory was applied as a return scenario. Fifth, for testing purposes, companies that qualify the criteria are considered into a 0, 0.5, and 1 weighted portfolio. As approaches 1, the investor becomes more optimistic and hopeful. Lastly, the resulting portfolio is compared to the benchmark market, which is the NASDAQ. This is done by comparing the return statistics of the portfolios. Now, let us go to the results. To give context, here are the data description. First, the backtest considers the daily trading scheme. Second, 500 historical returns for each semiconductor companies in the investment pool. Third, the backtest period covers 120 trading days before and 120 days during the COVID-19 pandemic from September 18, 2019, to August 28, 2020. Fourth, 3 portfolios denoted P0, P0.5, and P1. 0, 0.5, and 1 assigned as a weight for the portfolio. As a weighted portfolio approaches 1, the investor becomes more optimistic and hopeful. Lastly, the 3 portfolios were compared to the benchmark. Now, let us look at the return statistics of the portfolios. In P0, there will be no return or risk in both periods because the investor is too safe and afraid. Meanwhile, if the investor chooses P0.5 and P1 in the pre-COVID-19 pandemic period over the market, the portfolio will give the investor a higher return than the market, but with greater risk because of the higher standard deviation of the P0.5 and P1 compared to the market. However, when the investor chooses P0.5 and P1 during the COVID-19 pandemic, the portfolio will give the investor a higher and stable return than the market. Surprisingly, even the market is highly diversified. The effect of the COVID-19 pandemic in other industries shows in the volatility of the NASDAQ market during the backtesting, resulting in a higher standard deviation of the market than P0.5 and P1. Therefore, P0.5 and P1 are more profitable and less risky investments during the COVID-19 pandemic than the market. Graphically, we can see that both portfolios outperform the NASDAQ market in terms of cumulative return over the 240-day test period. The red line is the start of the COVID-19 pandemic. As we can see, the safety-first model's trend cumulative return of both portfolios is approaching a downtrend a few days before the start of the COVID-19 pandemic. However, during the COVID-19 pandemic, 2 portfolio SF models bounce back and dominate the market. The SF1 portfolio is more profitable and shows an upward trend at the latter testing days. And visually speaking, the volatility of P0.5 and P1 lessened during the COVID-19 pandemic. These results show that semiconductor stocks can be a reliable alternative investment with or without the COVID-19 pandemic. This study explores 39 semiconductor companies in the NASDAQ market with positive earning per share growth for the past 5 years serves as our criteria for our investment pool. P0 portfolio has no return or risk because the investor is too safe and afraid. P0.5 and P1 outperformed the market in both periods. P1 shows a significant performance with the highest return during the COVID-19 pandemic and lower standard deviation compared to the market. The study presents a simple variation to the basic portfolio selection framework by considering semiconductor companies as an investment pool and using the safety-first model. Fast-phase innovation and high-tech product demands during the COVID-19 pandemic could be the factors of stable and high-return performance of semiconductor companies, especially when almost the whole community relies heavily on gadgets to continue with our businesses, schools, and connecting with everything. This research study still has a lot of constraints and possible future improvements that can be made. Thank you for listening. If you have questions, feel free to ask. You can also email us through the emails shown.